So positions and leverage. So what is the LOS saying? Compare a position an investor can take in an asset. So if I want to get into the market, what are the types of position we can take? Long and short. That's what Vicky is saying. So you can either go buy the security. Why are you doing that? Why are you buying a security? What is your expectation? The price will go up, right? You will sell it at a higher price. That is the expectation. You're buying. Why are you buying? Not because if you expect the price will go down, will you buy? No, you will not buy it. The expectation is that it is going to go up. That means we call that position as a long position. Long. It's not that you're holding it for a long term. It's that your expectation is the price will go up. That is a long position. And we call that as you are bullish on the security. Okay. Bullish and long are the same, relatively same. Now, what is the other position? Short position. Short position is you first sell the security. Why are you doing that? Your expectation is the price will come down. You think that crude oil 85 is not good. Like, it's going to come down 60 when some geopolitical issues settle. Maybe it will come down. So then you might short the crude oil and then you will buy it back when it is at a lower price. In this one, we call your position as a short position or a bearish position on the underlying. Okay, so how do you do a short? Like you don't have the stock, so how can you first sell? Through the broker. Yeah, the broker is the one who facilitates that. But how is the mechanism work? See, if you want to sell a car, only if you have a car you can sell, correct? Like how are you going to sell a car that you don't have? What would you? Yeah. You ask your friend, give me your car. I will. You give me your car for one day, I will drive, but then you sell it, and so that might happen, right? Like here also we are doing something like that. Like you are borrowing from a market participant, but here we are telling that guy we are going to sell it. That is why I'm borrowing from you. You're selling it, and then hopefully, like if you are right, the price of the stock will come down, and then you will buy it back. Then you will return the stock to that guy. Okay, you have to return it with some payment. Okay, because you took that stock. In case there was a dividend or something, that also you have to give it back, and some amount you have to give. Thanks for the help. And then you give that and you make a profit, right? So that is your short position. Another type of position is using leverage, right? See, if I say that, Reliance is right now 2,800, let's say, I don't know the current price. Let's say that is the price. And I think, okay, we are using Asian Paints. Okay, let's say Asian Paints, the price was 3,172. I think when we looked at it at that time, that was the price. Now it has changed. Okay, now this is the price per share of Asian Paints. Now, if you have something like 3 lakhs, so you can buy 100 shares, right? So 3,172 into 100. So that is roughly 3.17 lakhs. But then you might really believe in Asian Paints. You think that it's definitely going to go up, but I only have 3 lakhs. I want to make more money than that. I'm not satisfied with just the 3 lakh investment. Then what do? Yeah, again, go to your friend, you ask for money, right? Like you borrow money from your friend and then you pay him the interest for that, but then you use that money and buy some stock. So basically your broker will give you what is called as a margin account, and in the margin account, they will let you borrow money at what is the margin call rate. Okay. So instead of doing this simple equity transaction, you are now buying on margin. That means at a levered position, you have some leverage. So just what happens, let's see one example. If I got this Asian Paints at 3,172 and then it went up to 3,480, that's a 10% jump, I would have made something like 31,000 if I didn't borrow. Right? I invested 3 lakhs, I made some 30,000, right? 10% profit. Now, if I had borrowed another 3 lakhs at say 12% interest from some broker, now I would have been able to purchase 200 shares. That is 6.3 lakhs worth of exposure to Asian Paints. Yeah. Now it is going up 10%. So you are making 62,000 in profit, right? But you have to pay this percent interest, right? So this interest you have to subtract. So this is 12% annualized, but this is for a month we are talking about. So that is 3,000 is the interest you subtract. So your profit is 59,000. So instead of making 31,000, you now make 59,000 in profit because you were right, obviously, and then you also borrowed. If you were wrong, this would have hurt us even more. So you have to be careful. Leverage, we call it as a double-edged sword. If you're right, it helps you more. If you're wrong, it hurts you even worse, right? So there are some calculations involved on the leverage side. So we have to understand these calculations. To get the leveraged return, how much was the return? You have to see the return on the portfolio minus the interest you pay divided by equity. Equity is the amount of money you put in, not the total amount, the amount of money you put in. Okay, that is the invested amount. Okay, in this case, the leveraged return 59,000 we made on the money we put in 3.17 lakhs, that is 19%. Even though Asian Paints went up only 10%, we are getting 19% return. Okay. The next formula is what is the leverage ratio? How much of debt compared to the total equity? So for that, we are going to use the total asset value, that is including debt. This asset is total portfolio, that is your investment, which we call as equity always, plus the amount you borrowed, that is your debt, the money you borrowed. So that is your total assets, right, divided by value of your investment or equity. In our Asian Paints example, we had total assets of 6.3 for 3.17 we put in. We've also borrowed 3.17. Total asset is 6.34 and our investment was 3.17. So my leverage ratio is 2 times. For $1 of investment, I have $2 of asset. 2 times exposure I have. So leverage ratio is 2x. Okay, now what is the amount of money that you can get? Depends on the broker. We call that as the broker will say this is the initial margin requirement. That is how much of the total asset you have to put in. If you're buying an asset, if you're buying for 1 crore, if they say we are okay with 30 lakhs, right? That is the initial margin is how much? 30% the value, right? For 1 crore, you need 30 lakhs, 30%, right? This is the initial margin. Why are they asking for this margin? Because if it goes, let's say you went long, if it goes up, everything is good. If it came down, the stock came down, they are going to use your margin to cover the losses. And if they are having losses, what happens is you have to give some cash or collateral, that is any security to cover the loss. In case the losses are very high and it breaches another level, let's say the starting in this whatever return is 50% is the initial level of amount you have put in, but the asset like maybe declines over time and then it breaches a what is called as the maintenance margin. So this one here in this example, I'm using 30%. If it breaches that maintenance margin, what happens is you have to put money to increase the assets back up to 50%. So there will be what is called as a margin call. The broker will say, you have to put money, otherwise you will close your position. Okay. So when the maintenance margin is hit, that is your 30% in this example, then they will say you have to give 20% of the value of the investment, total investment right now. Otherwise, you will get the account, the position closed. Initial margin, maintenance margin. If it breaches the maintenance margin, you get a margin call. Then you have to bring up the value of the portfolio back up to the initial margin level. So minimum margin is the least amount of money needed in the margin account at any point in time. If you breach that, we have to add additional cash or securities to bring the account back up to the initial margin level. What is the price at which we get the margin call? This is a very important formula. What is, if you are buying the shares at initial price of P0, what is the price at which you will get a margin call? You need to know that, right? You need to know. So that calculation formula is P0 into 1 minus initial margin divided by 1 minus maintenance margin. Let's say I am long Apple. Let's say we go long Apple. Apple is now at say 185. Now this is my long position. So my initial investment, this we call this as P0. The broker is saying your initial margin is 40% and your maintenance margin is 25%. Okay. At what price will I get a margin call? So if Apple goes up, will I get a margin call? From 185, if it goes up, will I get a margin call? No. If it comes down, will I get, at some point, I will get a margin call. The question is at what price? Okay. So you all know that the value has to be lesser. So like I know, so there will be some choices. Sometimes they will give you a higher price, right? If it is a long position, you will not get a call, margin call at a higher price. If it is a short position, you will not get a margin call when the price is going down. So this could be also a conceptual question, right? Will you get a margin call on a short position if the price of the security is coming down? Yes or no? No, you will not get it. Because that is going in your direction. Because in a short position, you want the price to come down. You already sold it and you want to buy it at a lower price. You will not get a margin call when the price is coming down. Okay. Now, what is the price at which we are going to get the margin call? 185 multiplied by 0.6 divided by 0.75. The denominator is going to be bigger because it's always going to be a lower number. So my 1 minus initial margin is 1 minus 40%, which is 0.6 divided by 0.75. So if the Apple share price falls to 148, then we will get the margin call. Now, let's say you purchased 100 shares initially. What is the call amount? How much money we have to pay to bring the value up to the initial margin? See, what you have to pay money. See, right now we are here in the initial margin. You have to bring it back up to that. Initially, you're starting there, no? Initial margin is what? At 40%. 40% of the total value. Total value is 185 into $100. So $185 into 100. So that is multiplied by 0.4. This is the initial amount you have put in, right? What is that? This is your initial margin. Okay. Now what has happened? The value has come down to 148 multiplied by 100. How much is that? 14,000. So initially you purchased assets worth 18,500. Now it is worth only 14,800. So what is the loss here? The loss is going to be 3,700. Okay. So we invested 7,400. Now it is 3,700 loss. So the remaining margin, 7,400 minus 3,700, which is 3,700. And if you divide it by the total number of total value of asset that we initially purchased, my margin currently 3,700 divided by 18,500, 20%. So this is the maintenance margin. Remember? So now to bring it back up to the initial margin, we have to invest another $3,700 to top it up, to bring it back to the initial margin. So I have to increase this 20% back up to 40%. That means I have to add 3,700 that we lost from the initial margin. The good till date or good for day is only for that day, the trading day, and the good till cancel is until it gets executed or cancelled. Then you have what is called as IOC, immediate or cancel or immediate or kill. If you place the order, it has to get executed right away. If it doesn't get executed right away, it gets cancelled out, IOC. So see, like you place a limit order at 185.20, you're expecting it to execute, right? So 185.20 I'm expecting it to execute. If it doesn't execute, that means the market has moved, right? The market is in a different position. I don't want the order to be there. If it doesn't get executed, I want you to cancel it. That is the instruction you're giving with the IOC order, immediate or cancel. You can also give good on close orders, good on open orders. These are more specialized ones. Not all brokers give you these options. So this is for traders. Like some of the orders will be available in the last 15 minutes or last 30 minutes. You place the order, but this order will get active in the last closing time, right? When the closing session starts, last 30 minutes or so. And some orders will be active only on the opening session, like first 30 minutes or so. And then after that, it will get canceled out. So GOC, good on close, or good on open orders. These are more specialized ones. If you are a trader, so you are worried about what? Losses, right? I mean, you should be worried about at least. So we want to limit the losses, right? So for that, we place what is called as stop loss orders. So we want to limit the amount of loss we are making. Let me say I bought Apple at 185.20. This is I am long, right? I'm long Apple I bought. So what is my expectation? It will go up. Now, if it starts to come down, Apple instead of 185, it's going up, it's coming down. Okay, now it is 183. Now I already lost $2, right? Now I want to close it. I don't want to take further hit. So the stop loss order will be like, this I have now bought. So the stop loss order will be like, for a buy order, it will be sell at 183. Okay. So this will go along with the buy order. So you're now buying it at 185.20. Along with that, you will also place a stop loss order that will say, in case it goes the other direction and it touches a certain level, I want you to close my position so that I don't take more losses. This is a stop loss order. If I had shorted this, so this is a stop loss sell order. If I had shorted this, what would I have done? I would have sold first. It will be a limit sell order at 185.2. Now, what would be my stop loss order? Stop loss would be a buy order. Correct? I will make loss when the Apple goes up because I have shorted it. Shorted means you want the price to come down. You want the price to come down. But if it is going up, you're going to be in a loss. So I will place a buy order. Stop loss will be a buy order at a higher price. Because as it goes up, I'm going to be at a loss. Because I've sold it, I'm trying to buy back at a lower price. But instead, it is going up. The price of Apple is going up. I want to limit my loss. I will do a stop loss buy order. Maybe depending on your amount of money you're willing to lose, at some price you will put it in, right? Yeah, if I am long, then I want to exit it at 183. If I am short, I want to exit at a higher price, right? Because that is when I'm at a loss. So I will place the stop loss order at a higher price. This learning outcome statement, they say, define the primary and secondary markets and explain how secondary markets support primary markets. Okay. So we know what is primary market. So we said this is where you do the IPO, initial public offering. This IPO can be done in a few ways. Okay. So first is what we would call as the underwritten approach, underwriting. Underwriting means like it's like a guarantee. And who is giving this guarantee? To the company. This is a guarantee that is given by the company to the company by the investment banks. And this underwriting can be done in a few ways. What is we will call the first one just like the regular guaranteed one, guaranteed underwriting. So we will say like, okay, the investment bank is talking to a company XYZ. They want to issue 1 million shares and they are saying we will sell it at $30 per share. So the total amount we are going to raise is 30 million. So what the investment bank is saying is we will raise 30 million and give it to you for sure. We are guaranteeing you that. Okay, this is a guaranteed underwriting. So in case they are not able to sell 1 million, they are only selling 900,000. The remaining, who has to buy? The investment bank only has to buy because they are guaranteeing that. They will give you 30 million end of the period. So usually the cost to do this is going to be high. They will charge 4% or 5%. If they're raising 30 million, the investment bank will take a cut of that, right? So they will take, okay, I want 5% to do this. Depending on the issuer, they will charge some commission. This is guaranteed. Then the next one is, we would call it as best effort basis. In best effort basis, they are not saying that they will sell all these 1 million shares, but instead based on the interest, right? People will express interest to the stock. They do what is called as road shows. The investment bank will take the pitch book of the company. They will go and meet all these investors who might be interested, institutional investors, high net worth, and they are trying to build the book. They are saying, okay, are you going to buy? Are you going to, then we will sell you at this price. So the best effort basis is, okay, I'm going to have some people interested at, say, $35. Then we have some 300,000 people interested at 32. Then we have 200,000 people interested at 30. Then maybe 400,000 interested at 28. Okay. So now I'm going to sell 1 million. I'm not guaranteeing any amount. I will just see what is the price the interest came in, and then I will sell it at that price. So investment bank is not taking any risk here. It is based on the expression of interest by the investors. You follow this? This is not a fixed amount that the company will get. So this is best effort basis, which is good for the company. What do you think? Guaranteed, or if you are an investment bank, what will be the price you quote? This $30 per share, will it be high or low in a guaranteed underwriting? Low, because if you quote high, then if you're not able to sell, you are holding the bag, right? So there is a conflict of interest when you are doing underwriting. If you're guaranteeing, they might not give the best price to the company. You follow this? So instead of raising this at 35 million, they might only say we will be able to raise it at 30 million. You follow that? So yes, the fee, you know this amount is guaranteed, but your valuation that you are getting might not be the best when we are doing a guaranteed underwriting. Do you understand why it might be? Because there's a conflict of interest in your guaranteed underwriting. Because the investment bank is at risk if they quote the price too high. Whereas in the best effort basis, they don't have a liability. They are just seeing the market, whatever is available, and then they are filling the order. So sometimes, yes, you don't have the guarantee of raising a certain amount, but you might actually get a better amount, price, and the total amount you get for the dilution might be higher when you do the best effort basis. Okay. Usually the commission on the best effort basis is lower because they are not guaranteeing the IPO process. The amount they are not guaranteeing. There is also a bidding or auction process. So this is what Google did, back in 2004 or 5. So instead of using this investment bank, they can just go directly to the public. You say, you bid the price, you say what is the price you're willing to pay, and then we will raise the money and give it to the top people. Right? So that is bidding or auction. Then we have shelf registration. Shelf registration. What is shelf registration? What is shelf? You keep something there. Whenever you want, you take it. It's like that. You go do all the filing, the documentation required for the IPO, but you will raise the money whenever it is needed. Okay? So you do the registration for IPO ahead of time, but then you will get the actual funds whenever it is needed at a later time. Have you guys heard of this term rights offering? What is a rights offering? For existing shareholders, they give existing shareholders the right to buy new shares, and usually at a subsidized or reduced price, discounted price. That's a rights offering. Then there is something called as DRIP, or dividend reinvestment plan. Right? So this is if you have a stock, you're going to get some cash back. Whatever is the net income, some of it is given back to the shareholders as a return, and that can be used to buy new shares. Instead of taking cash, they will use it to buy new shares. So that is going to go back as a cash flow to the company. So this will also reduce the transaction cost. Sometimes it can be also given at a slightly lower price, at a discounted price to the market.